Dirty dealings, corporate battles, consumer woes. This is Evening 5. IJM Corp's proposed acquisition of a 44.83% stake in Pestech International in a 124 million ringgit cash deal of 15.5 cent per share has fallen through. In a Bursa Malaysia filing, Pestech announced that the subscription agreement, which would have made IJM its largest shareholder, has been mutually terminated due to non-fulfillment of the conditions precedent outlined in the agreement. As such, the board decided to abort the proposals. However, Pestech noted that the termination of the agreement does not affect the existing JV with IJM Construction for the aerotrain at the Kuala Lumpur International Airport. The contract value for the aerotrain involving the IJMC Pestech JV stands at 175.65 million, with IJMC holding a 60% interest and Pestech the remaining 40%. Termination of the share purchase plan would mean a return to the drawing board for Pestech's recapitalization exercise. Cash-strapped Pestech added that the board is currently exploring other alternative fundraising proposals to meet its funding requirements, the details of which will be announced in due course. To recap, on July 24th last year, IJM signed an agreement to acquire the stake in Pestech to enhance its presence in the railway construction segment. In the following month, Malaysia Airports Holdings terminated Pestech's 742.9 million aerotrain replacement contract at KLIA1. Subsequently, in January this year, an IJM-led consortium including IJMC, Pestech Technology and Alstom Transport Systems was appointed to complete the 456.1 million ringgit aerotrain replacement project. Speed Mart Retail Holdings launched Malaysia's biggest initial public offering in 7 years, raising up to 2.36 billion when it finally goes public on the main market. The IPO is priced at 1 ringgit 65 per share, and the retail offering will close on August 23rd, while the institutional tranche will end on August 27th. The listing is scheduled for September 9th. If successful, the IPO would raise the most funds on Bursa Malaysia since July 2017, where Lotte Chemical Titan Holding raised 3.77 billion ringgit. Currently, 99 Speed Mart operates more than 2,600 stores in Malaysia, selling everything from toilet paper to eggs, and targets to raise the number of outlets to 3,000 stores by end 2025. Alternate Director Albert Lee at the prospectus launch said that there is still room to grow its number of outlets, especially in the northern and eastern regions of Peninsular Malaysia, as well as in Sabah and Sarawak. According to the company, each of the outlets generates average monthly sales of 350,000, while high-performing locations could hit about 600,000 ringgit per month. The public issue would raise up to 660 million, and the company has earmarked nearly 59% of the proceeds for expansion of its network of outlets. Around 15% will go to setting up new distribution centres, 8.3% for purchase of delivery trucks, and 7.2% to upgrade existing outlets, among others. The IPO will count among its 14 cornerstone investors fund managers, AHAM Asset Management, Areca Capital, as well as the Employees Provident Fund and Social Security Organisation. The offer for sale portion, meanwhile, would gross about 1.7 billion, which would accrue entirely to selling shareholders Lee Tiam Wah, who is also the CEO of 99 Speed Mart, and his wife, Ng Lee Tieng. Pharmaceutical company Duopharma Biotech saw its second quarter net profit grow 33% year-on-year to 16.69 million as top line also grew. Revenue for the current quarter rose 30% to a record 218.3 million from 167.5 million, predominantly driven by robust performance in the prescription market, particularly the public health segment. As a result of the better numbers, Duopharma declared a first interim dividend of 1 cent per share, amounting to 9.62 million for FY 2024. However, for the first half, net profit declined 9% to 32 million, which Duopharma attributed to changes in the product mix, coupled with increased operational costs associated with full operation of its newly completed K3 manufacturing facility in Klang, higher finance costs, and unfavorable exchange rates. This was despite revenue increasing 11.8% year-on-year to 411.3 million, driven by increased sales in prescription pharmaceutical markets, ethical specialty and export segments, which helped to cushion the marginal drop in sales in the consumer healthcare sector. Group Managing Director Leonard Arif Abdul Shatta said the strong financial performance reaffirmed the group's strategy and reinforces its commitment to delivering high-quality healthcare solutions and expanding its market presence. He adds that the group is particularly enthusiastic about its international ventures and sustainability efforts, which he says are key to its long-term vision. While he acknowledges that cost challenges remain, Leonard says that Duopharma remains committed to enhancing internal efficiencies and that coupled with the new supply agreements with Pharma Niaga Logistic positions the group favourably for the rest of FY 2024. Pestech Heavy Industries Corp announced that its 51% owned JV, BHIC Aero Services, has secured a $378 million contract to provide in-service support and performance for the Royal Malaysian Air Force's EC-725 helicopters. In a BOS filing, BHIC said that the letter of award, dated August 2nd, was issued by the Ministry of Defence, representing the Government of Malaysia to BHIC AS. The contract is for a period of 5 years, commencing from the date of acceptance and signing of the LOA, with a formal contract between the government and BHIC AS to be finalised and executed at a later date. BHIC said the contract will positively contribute to its earnings for the 2024 to 2029 financial years. BHIC, 64.99% owned by the Armed Forces Fund Board, reported a net loss of $6.67 million for the first quarter, following a net loss of $6.5 million for the same period in the previous year due to higher operating costs and lower contributions from JV companies and reduced customer demand. Property stocks fell on heavy trading in the morning session on Thursday. The largest losers were SP Setia, down 16% to RM1.28, and Sime Darby Property, down 8.7% or 13 cent to RM1.36. In the morning session, the two were the most traded across Bursa Malaysia. The Bursa Malaysia Property Index, which tracks 98 constituents, was the largest losing sector, down 2.8% or 30.25 points to 1,049.13. Of that, 50 of the 98 property components were down. Other large cap property stocks that fell heavily were UEM Sunrise, 3.85%, IOI Properties Group, 2.79%, and KSL Holdings, 2.25%. Market observers attributed the heavy selling to the larger-than-expected loss from the Battersea project, which also dragged on Sime Darby Property and sparked profit-taking across the sector. Despite the heavy sell-down on Thursday, SP Setia's and Sime Darby Properties' year-to-date gains stood at 60% and 117.6% respectively. SP Setia eventually ended the day 15% down at RM1.29, while Sime Darby Property closed 12% down at RM1.31. A few research houses have downgraded SP Setia due to unexpected higher losses from the Battersea project related to the guaranteed rental agreements provided to buyers of an office tower. There were also policy concerns about higher affordable housing requirements for property developers. Meanwhile, some brokers think that property stocks have ran way ahead of fundamentals and find it increasingly hard to find value among them.